Hi, this is Alan Gassman, and I'm going to show my screen now. Okay, I'll start over. Hi, this is Alan Gassman. I'm here in the Gassman Ketron studios in Burbank, California. We're about to go to Disney World or Disneyland, but before that, we wanted to have even more questions and answers on estate tax planning. So apparently there's a lot of people into masochism at S&M because this is the third webinar we've had on estate tax planning. And we'd like to thank our sponsor, Bernie Sanders, who was kind enough to actually submit a bill onto the floor of the Senate, which had what we believe are some unrealistic proposals based upon the present political climate, but also some realistic proposals. And we're going to talk for maybe 5 or 10 minutes and tell you what those proposals are. And then we're going to get into some questions and answers. We appreciate all the questions we've gotten. And then we're going to show you some actual plans that we designed in the last week. And that way we can charge those of you whose plans these are for our time giving this webinar. So thank you very much, clients big and small, for helping us here. Let me first, however, plug a free webinar that I'll be giving on Tuesday at 12:30 on smart tax giving to charity. Now, we're doing this with the University of Florida Charitable Foundation team, especially the law school team, but this should be of interest to anyone. And in addition, with St. Petersburg College on Wednesday, April 21st, also free with Dr. Luz Randolph, we're going to talk about a survey of charitable gifting vehicles, and I have a brand new chart that I started this morning that I'm very proud of. One thing that Brandon and I thought about this week and that we're doing for a few clients is the Qualified Personal Residence Trust. The Qualified Personal Residence Trust is not under fire under the Bernie Sanders plan and is a way for me to get my home and one vacation home out of my estate in a tax efficient manner. So if that's of interest, we have a link here for you where our partner, Ken Crotty, gave a really good talk on QPRTs and GRATs in 30-minute flat. So you could see that at your leisure. And then in the not so free department, especially for those of you who are tax professionals, Professor Jerry Hesch joined us for a very interesting 90-minute or 100-minute conversation on Tuesday, April 6th, and that's available in the Limeberg system. We regret that we cannot make this available for free, but Professor Hesch needs the money, and we can send you our slides for free if you just email us and say, send LISI slides. Otherwise, you may want to know more about it. So for those of you who read the Thursday report, which, by the way, comes out on Thursdays, we promised that we would review these particular slides. And I now have a new feature. I have a touch screen on my computer, so I can actually make things bigger or smaller just by holding them with my fingers, like on my phone. So if you don't have one of these yet, you might want to get them. I think they're only a couple $100 and is a really nice thing. But let me, oops, my slides stopped working. Brandon, are you able to advance the slides?
Let's see.
I don't know why.
It might be because you're still trying to zoom in and out. If you go all the way down, it might give you control back. There we go.
Oops, all right, let's see what this is. All right. Brandon is more technically oriented than me, being younger, but I've got an hourglass issue. Now it's going to reopen. Now it's another slide I didn't want. Now I'll open my emails, find the slide again. Brandon, while I'm doing this, do you want to explain the new estate tax system without the help of prompters?
Couple of things that the Bernie Sanders proposal is proposing to do. The first major one is reducing the current estate tax exemption down from $11.7 million per couple to $3.5 million per individual. So that would be $7 million for a married couple. That would take effect in the first of next year. So significant reduction in the estate tax exemption amount. The other thing that's related to that is under current law, we have an annual, like a lifetime exclusion. You can either use it for gifting or you can use it for on your death for estate taxes. And the Bernie Sanders proposal would really bifurcate the two instead of making them tied to each other. You'd only have $1 million lifetime exemption to make gifts. And that would also be effective at the first of next year. So a different change there from the current law. The rates would be increased slightly, up 45% at the minimum, up to a maximum of 65% possibly for larger estates. And let's see, Alan, can you see the slides now? Am I have the right screen? So looks like Alan dropped off there. So the other proposal that Bernie is planning on doing is grantor trust, which is a vehicle that we all like to use. Grantor trusts are essentially treated as tax to the creator of the trust. So whoever funds the trust pays the income taxes on the trust. That's not deemed to be a further gift to the trust. So it's a really valuable tool for estate tax planning because you can pay the taxes, which reduces your estate, and allow the assets that are going to pass to your beneficiaries to grow income tax free. So very effective planning tool, and the Bernie Sanders bill would essentially say if we have a grantor trust, that's now going to be included in your estate. So not nearly as effective as it once was, and will essentially be no longer able to use grantor trust for estate tax planning. The other part of that is when you make transactions between a grantor and the creator of the trust and the actual grantor trust, that they're disregarded. So there's no taxes payable on sales, and that would also be eliminated because of the grantor trust being included in your state. The couple of other minor things, GRATs, Grantor Retained Annuity Trust, where if you contribute assets to a trust and you get an annuity interest back, that is going to have to be a minimum of a 10-year term, remainder interest of at least 25%. Some of the more technical planners will understand what that means, but I won't go into detail from that. If you want some more detail on GRATs, Ken has that excellent presentation to walk you through the details of those. A deemed termination of trust will occur every 50 years for estate tax purposes. So under current law, you can allocate generation skipping tax exemption to a trust, and it can go as long in the state of Florida for 360 years without being subject to estate tax. That's going to change under Bernie Sanders bill. Every 50 years, there'd be a deemed liquidation, and there would have to be taxes paid on the trust to the extent that it exceeds the estate tax exemption level. There's some other changes here related to annual exclusion gifts, where you can donate currently $15,000 per individual. You can make that $30,000 per married couple if you split the gift with your spouse, and that's going to change if you make a transfer to a trust. Now, if you had, say, 4 beneficiaries on the trust, you could put $120,000 into the trust, and that would all be under the annual exclusion because you're not exceeding $30,000 per beneficiary. Well, now if you make a transfer into a trust, that's going to be capped at just one $30,000 exemption. So therefore, that type of planning will be limited under Bernie Sanders' bill. So they really threw everything but the kitchen sink here into this bill. It'll probably be negotiated down. We'll probably get a little bit of this and a little bit of that into whatever bill does end up passing, but we'll just have to wait and see what happens here. So. See, Alan, I'm seeing the upcoming events dashboard on your slides there on your screen, not the slide deck. And I think you're muted as well. Still muted.
How about now?
There we go. Now we're back.
All right. Well, definitely having slide problems today, ladies and gentlemen, which I do apologize for. Let me try one more time here. Brandon, I think one question we get a lot of that you may as well cover while I'm trying to recover my slides is how does a qualified personal residence work? And how can that be used by a family who gets caught in this estate tax quagmire and would have to pay estate tax on their home?
Yeah, so it works similar to the way the GRAT works, in that you would contribute the house and your residence to a trust. In exchange for that, you would receive an annuity back equal to a discounted value of the current home. And upon the expiration of the annuity term, the house would be outside of your estate for estate tax purposes. And the only catch is you would then have to start paying rent to this trust for the use of the residence. But that's a good thing as well, because that also further reduces the value of your estate. So it works really well from a planning standpoint to effectively get a personal residence out of your estate into the hands of your beneficiaries and future generations. And that way you don't have to pay tax on that personal residence upon your death.
Okay, so slide 34. Brandon, can you see slide 34?
I can, yep.
Wow, okay, that was easy. Okay, in the past, I've been told I should not need an irrevocable life insurance trust or a qualified personal residence trust because we are expected to be well under $11 million as a married couple, even after the estate tax exemption goes down to 2026. We have $1 million home, $1 million in death benefit term life insurance, and $7 million of investment assets. And I guess their math isn't really good for this particular married couple. They must have some other assets as well. We'll also qualify for pensions when we retire, so we expect our estate will grow and not get smaller. So yes, you could put your residence in a qualified personal residence trust, maybe a 10-year qualified personal residence trust. Maybe that'll be a $600,000 gift. And then if you live the 10 years, whatever your house is worth will be out of your estate. And yes, you could put your $1 million life insurance policy into an irrevocable life insurance trust, which we in the business called an ILIT. And then the life insurance will not be subject to estate tax. And then the next question is, will these vehicles be available after the Sanders bill passes? If it does pass, and the answer is yes as to the QPRT, and probably as to the life insurance trust, although the way the Sanders bill is drafted, a new life insurance trust would not work because it's considered to be owned by the grantor for income tax purposes. So either our industry will create a workaround for that, and I'm not sure what the workaround is yet, but I'll bet there will be one, or more likely, lobbyists will donate lots of money from the insurance industry into the congressional reelection coffers, and you will find that life insurance will be exempted. It enjoys every loophole possible in the tax area. So I think that works. Any comments on this, Brandon?
Yeah, no, I think they're at currently $9 million, of an estate. So certainly, if the exemption were to drop to the 3.5, they would be estate taxable. So exactly as Alan mentioned, contributing that $1 million to a life insurance trust potentially could be a way to move $1 million out of the estate. The QPRT is also another way to move the home out of the estate. You'd probably have to pay a little bit of gift tax or use a portion of your exclusion to make that happen. And then there's things we could do with the $7 million of investment assets, maybe contribute those to an LLC, bifurcate the voting interests, so that way you don't have voting control with a trust for your descendants possibly, which would allow for a discount to occur on the value of the investment assets. And that might get them close to underneath the Bernie Sanders proposal. So there's
right, because a 99% non-voting interest in an LLC owning 7 million investments may be worth 5 million or 4.5 million, and then you could sell that 99% to a trust for your favorite spouse in exchange for a note. So, and if you're not sure what I mean by your favorite spouse, send me an email and I will explain it. Okay, so Brandon, here's another question. If we form a life insurance trust for my life insurance, can we have access, excuse me, to the cash value?
So I think no, the cash value would be held under the trust for the benefit of your descendants. it's possible that you could set it up under a slat where your spouse would be a beneficiary of the trust, and then the spouse could potentially have access to the cash value, but you as the owner of the life insurance and the funder of the trust would not be able to have any control or access to the cash value.
Well, there's a possible exception to that, and that is by using what we call split dollar loans.
Right. Yep.
So if I have a policy worth $600,000 that's a $5 million policy on my life, I think I could put that policy into an ILIT, a life insurance trust, and have it owe me a note for $5 million secured by the life insurance trust and bearing interest at anywhere from a reasonable market rate down to the low applicable federal rate. So I think that kind of planning will be available. Okay, you have said that you do not like to do reciprocal slats. Can you explain why? And what is a reciprocal slat? Well, I form a trust for my wife, Marcia. She's the trustee. It's for her health, education, and maintenance. She can direct where it goes when she dies, even though she might direct that it would benefit me after she dies. By the way, I'm not hopeful that she would actually do that. And then after her death and my death, it could go into separate trusts for our children. And that's called a SLAT, a Spousal Limited Access Trust. And it's probably the most popular vehicle right now for estate tax planners. Well, if I do a SLAT for Marcia, I would certainly appreciate it if she would do a SLAT for me. But there's something called the Reciprocal Trust Doctrine, which says that if I set up a trust for Marcia and I'm the beneficiary, and she sets up a trust for me and I'm the beneficiary, then it's like we set up trusts for each other and they're reciprocal. And under Florida law, if I set up a trust for myself, it's subject to estate tax when I die. Now, the tax court has been very generous. There's a case called U.S. v. Grace, where Mr. and Mrs. Grace set up trusts for each other. They weren't exactly alike. They were different enough that the court said that the reciprocal trust doctrine didn't apply. But I'm not so sure that the IRS and the tax court got that one right, because they did not mention in the decision that under Florida law and the common law of England, which was adopted by Florida when Florida became a state, if I set up a trust for Marcia and Marcia sets up a trust for me, at the same time, our creditors can reach into those trusts. And if I set up a trust that my creditors can reach into, then that is going to be subject to estate tax when I die, because I can benefit from it from running up debt. So I don't think that the case law now on the books reflects this issue. And there's another issue that a lawyer named Jeffrey Baskin from South Florida brought up when he read these cases carefully. And I'll be glad to send you his analysis of this if you send me an email, because it's an excellent analysis. But that's why we will typically do one trust where the spouse, who's usually the higher earner with the shorter life expectancy, also known as the husband quite often, will set up a trust for the wife and descendants, or for the younger non-earner spouse and descendants, to be gender neutral here. But then the other spouse will form a trust just for descendants, and maybe put that trust in Nevada, where creditors should not be able to reach it, and put in a provision that if the first spouse ever becomes insolvent, which is highly unexpected, that officers called trust protectors could add the person. Maybe that works. We feel pretty comfortable with it, but we don't feel comfortable with reciprocal Florida slats. Okay, Brandon, I thought this was a good one. I think it's great that you can help me preserve my wealth from taxes, but how can I preserve it from being wasted by my children who are not yet mature, or who may never, ever mature, or their future families who I have not yet met?
Yeah.
Brandon, you're the younger member of our team. How can we preserve our wealth in spite of your generation?
Yeah, really, really good question. And our generation's notorious for this, right? The spend money like crazy, not be worried about debt. But the way you do this is you appropriately draft the trust document. We're talking about this in generalized terms, but there's nothing that would prohibit you from in the trust document saying, I want to limit this to only, say, $10,000 a month for my kids, and that's it. Everything else they're going to have to earn on their own. Or you can say if they earn $5,000, they can get $5,000 from the trust, something along those lines. And, even you can go as far as, I only want this to be available for education, health, and medical emergencies, nothing else. You don't get maintenance or support. You just only get it for these limited purposes. So you can define and craft trust language any way you want to, and that's still effective from an estate tax and wealth preservation standpoint as well.
Yeah, one of my favorite authors is Robert Heinlein. He wrote Stranger in a Strange Land. And he said, don't ruin your children's lives by making it easy. And we do see, as estate planning and trust lawyers, we see a lot of young people inherit a lot of money and then do nothing with their lives. So a clause that would limit them to a certain dollar amount per year, having required co-trusteeship right up until retirement age or even longer, is something that your children may thank you for later if you have a large estate. The other alternative is to name Brandon and I as beneficiaries of your estate. All right, page 38. This person has a $9 million IRA and their house. And besides putting the house in the QPRT, how can she make a large gift? She only needs about half of her IRA to retire comfortably with her pension. But how do I make a $4 million gift to get myself down below what I think the exemption will be without paying income tax on the IRA? And Brandon, do you know the answer to this one?
I think you got to pay the income tax on the IRA, right?
I disagree. I think that you can set up an irrevocable trust for your children and sign a $4 million promissory note bearing interest at 5 or 6%, payable by you to the trust, and probably also sign an agreement that you will not seek to protect the IRA from creditors under the creditor rules. Go ahead and file a $400,000 gift on your gift tax return, reducing your exemption from 11,700,000 to 7,700,000. Make interest payments on the note, treat it as a pure note, get something in return for the note, such as your child agrees not to smoke marijuana on your birthday, something material to make it enforceable under Florida law. And then when you die, we're going to file an estate tax return, but it's going to say IRA 9 million, home 1 million, debt owed 4 million, net estate under 6 or under 7 million. So we did write an article on this years ago, and we'll be glad to share it. It's a Steve Lineberg article. Brandon, any comments on that?
Yeah, I'm just wondering about if the IRS would respect the note. But I think, as you mentioned, you might have to get something in return. Would make it look better from a,
Yeah, there's a whole lot of law on this, and you have to get something in return for the note, but it can be something, there's an old English case where a son agreed to read 4 books, and if he read the 4 books, then the note was enforceable. So, and probably they could be comic books even. All right, page 39. Number 1, to be clear, there's no inheritance tax to anyone owed to the government until the second spouse dies. That's correct if you've done your estate planning properly and you're using the marital deduction in your documents. I don't assume that, though, because we see a lot of mistakes. Number 2, unless both spouses were to die in an accident, as long as each spouse has their trust say that upon their death, all the money goes to the other, what is the reason to do anything else? In light of the fact that we know that unless the exemption is lowered by Sanders' bill, which doesn't have a snowball's chance of passing, nothing will take effect until January 2022, and that for the next 3 years until Trump cuts sundown, we have 11,500,000. I understand the necessity to be educated, but I have a second to die policy in place and clearly feel waiting and watching what evolves seems more prudent than making big changes now. Thoughts? Well, you've got to start sometime. This is what we hear a lot from a family that might have a $13 or $14 million net worth. If it's reasonably invested, it's going to double. If it earns 7% after taxes, it's going to double every 10 years or every 15 years. So unless you set up one of these slats or one of these defective grantor trusts and make a large gift or a large discounted sale, you're going to be in harm's way eventually. And if and when the Sanders bill passes, you're not going to be able to do these disregarded trusts or these discounted long-term sales. So we would at least try to get that into place. But this is a common question and attitude that we face. And when a client dies and the family pays a lot of estate tax, I just think about survival of the fittest. This family was smart enough to inherit or earn tens of millions of dollars, but not smart enough or agile enough or trusting enough to do the estate tax avoidance work. And I'm sure that the tax professionals on this webinar agree with me that this is a frustration.
Yeah, and I think a common misconception too is that to do estate tax planning, you have to give away everything that you have. And that's not necessarily the case. A lot of what we do is essentially freezing the value of what you have today and passing the growth to future generations. So, you know, you don't have to be concerned about going broke and giving away everything to your kids. You can freeze what you have today if that's enough and pass the growth on to future generations estate tax free.
Yeah, and I'll also mention, if I die, Marcia does get my $11,700,000 exemption, or what remains of it. But if she remarries and her new spouse dies before her, then she'll be stuck with that new spouse's exemption, which may be zero. So you can't rely on the portability. If Sanders gets this bill passed, you're going to be stuck with a $3.5 million exemption. The other thing that is not unlikely is usually the effective date of a law is not when it's passed. Usually the effective date of a law is when it is proposed by the House Ways and Means Committee. So if we get a House Ways and Means Committee proposal in the next few months, which says no more discounts and no more defective grantor trusts, and you haven't done one, then it may be too late when it comes out of House Ways and Means. And then you can't really predict when it's going to come out of House Ways and Means. They're kind of secretive about it. So yes, none of this may happen, but some of this may happen. So you just have to be careful. Okay, most of your information seemed to pertain to couples. I'm widowed and now considered single with a grown child. How would you suggest planning for trust? Well, we would suggest planning for trust. You can set up an irrevocable trust for your grown child and put assets into that trust. And if you do it more than 5 years before you die, then Medicaid can't touch it. Or if you do it in Nevada, you may be able to get it back if you need it. But now that you have an $11 million exemption, sometime this year, you may want to put a big chunk into a trust for your child, knowing that you have enough. If you're not sure you have enough, then we would think twice or think about another situation. I would also encourage you to date and marry somebody very, very, very wealthy so that the problem even becomes worse. Page 41. Most of your examples deal with married couples with assets over 40 million. What might be the estate planning techniques you would recommend for a single person with 2 children, assets of 10 million, 2 million of which is in retirement, and 6 million of which is in real estate with a low basis? Well, the first thing would be to remarry somebody who's wealthy so that you would have $40 million so that we could help you. But the real answer here is see what you're comfortable that you need to keep, and then see how comfortable you are putting some of the rest into an irrevocable trust that may owe you money so that at least the future growth would be out of your estate. And you do have to twist and turn a little bit here, because if you die, the real estate gets a new $6 million basis and your kids don't pay capital gains tax, but it may be subject to estate tax. Whereas if you put it in one of these trusts and you die, you may not get the step up and the kids may eventually pay capital gains tax. So really you have to educate yourself as to what the alternatives are. And then, as one of my friends in high school used to say, you place your bets and you take your chances. But doing nothing is usually not the right choice there. Okay, page 42. Will contributions by grantors, the insureds under a second to die life policy, to a grandfathered life insurance trust, cause the proceeds of the policy to be included in the estate of the insureds? We don't think so. We think you'll be grandfathered. How can contributions by the grantors after 2021 that exceed the $30,000 per person Bernie Sanders limitation, work if the bill passes? Well, you'll start loaning money to your life insurance trust using what's called split dollar loans, or you'll start using part of your exemption if this comes about, or you might have your children start loaning money to the life insurance trust because they're the ones that are going to benefit. So Brandon, if you could answer number 2.
Yeah, so will $15,000 per year per grandparent per grandchild still be allowed to contribute to 529 plans? And yes, the answer is that yes, you can. There's nothing changing with 529 plans. You can still utilize that 5-year kind of bunching where you can contribute up to 5 years of your exemption in 1 year. So $75,000. That's not going to change and then have any impact here under the current Bernie Sanders proposal. So that would all still be allowed.
We think that'll be allowed. The Sanders proposal does say, though, that you can't gift more than $30,000 to a vehicle where the donee doesn't have control. So you might have to turn the 529 plan control over to the child in order to not have the limitation. We don't know yet, but you know what? If you're going to go ahead and fully fund your 529 plan, do it. Not only for estate and gift tax purposes, but to get all the income tax advantage. I get a lot of wealthy people who come in with a 3 or 4-year-old child or grandchild, and they say, well, I'll do the 529 plan ratably until the child is 14. Well, why wouldn't you get the whole 200,000 in there now so the growth is tax-free? There are ways to do 529 plans without them being considered to be gifts for state and gift tax purposes as well. So interesting stuff. Okay, I have one additional question to the 2 previously submitted. If beginning in 2022, a grantor insured can no longer make a contribution to an ILET without the proceeds of the policy coming back into his estate, in order to make payments on premiums coming due, can the grantor loan the ILET money? Yes. Can the ILET deduct interest paid back to the grantor's estate on the grantor's death? I don't know. I would think not, but I don't know why that would be. I'm going to have to ask Jerry Hesh that. He's the grandmaster in that area, and get back with this. Page 45. Can you compare and contrast a SLAT with a disclaimer to lifetime Q-tip? Brandon, you want to talk about that? Because that's a hard one.
Yeah, so the lifetime Q-tip trust is a trust that provides that the spouse has to receive all income at least annually. They have to have the ability to make the trust assets productive. So there's a lot of restrictions that you would have to draft into the trust document to get it to qualify as a Q-tip. And comparing that with the SLAT is that the SLAT can really be, you could craft it any way that you would like. You know, the spouse could receive limited distributions, the spouse could receive the income if you would like. I think the catch here is the Q-tip probably not going to be as effective from a asset protection, creditor protection standpoint, because distributions would be required each year. But as far as flexibility, the disclaimer planning with a lifetime Q-tip, you can make a transfer to this Q-tippable trust, and then you would have 9 months to decide whether or not you want to make the Q-tip election for that trust. If you make the Q-tip election, then it would be qualified for the marital deduction, and you would not be treated as having made a gift to that trust. So it does provide a little bit more flexibility versus just funding the SLAT, which is if you didn't draft the SLAT appropriately, then you would not have the ability to undo the gift. So I think that's really the comparison there. And they do mention the disclaimer planning. I think one of the issues with the disclaimer it's a little unclear who exactly has to make the disclaimer. I don't know that that's really been fleshed out appropriately, and then how that's going to work. So there's a little risk involved there. The lifetime Q-tip pretty clear that the marital deduction would apply to undo the gift. So that's a little bit more sound as far as making the disclaimer under the slab. So Alan, any additional thoughts there on those?
Yeah, yes, there are ways to do a trust for your spouse and descendants that can be reversed out next year if it turns out that the estate tax doesn't change. But these things are a little bit complicated. They can be discussed. Let's go, we're kind of out of time here. I'm going to do one more question. Then we're going to answer the rest of the questions by email or next Saturday. But we're going to spend about 20 minutes after this going through some actual client situations so that the clients will be able to watch the video later. But this question, what's the fate of the step up in basis under the proposed regulations? Well, there's no proposed regulations. Bernie Sanders didn't do anything about the step up in basis, which means when I die with stock worth $100 that I paid $10 for, the basis comes up to 100. That's called a fair market value date of death basis. And then my children can sell the stock, say, for 120 and only pay $20 capital gains tax. Sanders only tried to do away with the stepped up basis in a trust that is outside of your estate but considered to be owned by you for income tax purposes. That's probably the approach that the IRS takes now. What will happen to incomplete or complete gift, grant, or trust under the proposed rules? Well, if you had a trust that doesn't pay its own income taxes, then it would be considered as in your estate for estate tax purposes. But Sanders would grandfather any of these trusts that exist beforehand as long as nothing's added to them or changed. And that's why a lot of people are taking advantage of his warning shot over the bow and setting these trusts up. So,
and there is a separate proposal that would eliminate step up in basis, but who knows? I mean, it's just in the same boat as this Bernie Sanders proposal. We don't really know what's going to happen with that bill either. So it is a potential that could be eliminated. There is a proposal, but I don't know how well supported it is.
Now here's our new chart for the day. We always like to have a new chart, and thanks Debbie for coming in early this morning and making the chart happen. When I sell assets to my children or I loan money to my children, right now for May of 2021, if it's a 9-year or longer note, I have to charge at least 2.15% interest. Look how these rates have come up. If you had done this planning for us with a loan in January, we could have done 1.35% for 20, 30, or 40 years. Now it's 2.15%. It's definitely edging up. Now, if you make an installment sale, you can use the lowest of the three of the month in progress, which is May, right? Which will be May next month. So if you do this in May, then you can use 1.61%. If you get it done in April, you can use 1.45%. The midterm rate is up for a 9-year note, anything over 3 or up to 9 years, 1.07%. Almost, or actually more than double what that rate was in January. And then the short-term rate is only at 0.13%. So my gosh, if you have $10 million, you could loan your grandson $10 million. He or she could put that money in a bond fund, earn 1 or 2%, earn $200,000 a year, only pay you $1,300 a year, and keep the difference. Of course, that's probably not what they'll do with the $10 million unless you have a detective follow them with a gun. But still, that's what you can do, is have these transactions between you and a trust. And I think we covered that pretty well last week. So let's go through a couple of charts here. And this was one we did last week. This was a call I got this week. And the husband and the wife have about $8 million in assets, and they want to do something right away. So the husband has about $1,944,000 in assets. Jointly, they have 3.4 million. The wife has 3.9 million, and they have a lot of other assets, but these are the assets that they are interested in gifting. So the first step for them is we're going to set up a limited liability company, and we're going to contribute those assets to the limited liability company. And when you look at the relative contributions and you run the numbers, the husband is going to get 39.9% of that LLC. The wife's going to get 60.1%. And then what we're going to do is we're going to reduce them by 0.5% each, so that they jointly own 1%. So husband will have 39.4%. Wife will have 59.6%. And then we're going to set up a husband is going to do a trust for wife and descendants, also known as a SLAT, and he's going to sell his 39.4% interest. And let's go back, that's worth about $3.4 million when you do the numbers under the LLC. But because he's getting a non-voting interest that he is going to sell, we can call that a $2,382,000 sale. So he's going to put about 10% of what the sales price will be in cash into this trust. Then he's going to sell this for a $2,382,000 note, get about $1.1 million out of his estate, and get the future growth of this LLC out of his estate. And husband and wife are going to pay the income tax on what grows. So this is going to actually reduce their estate going forward as opposed to increase it. Now, wife doesn't like husband so much, so she just does a trust for the descendants only, and she sells her 59.6% interest, which pro rata is worth about 4.8 or so, or 5, and she sells it for a $3.6 million note. So the same thing, it's a low interest note. So they now have $5,900,000 worth of notes instead of much more of assets. They've got the growth out of their estate, and their children will be very happy. Now, what's the downside? Well, they've got to spend some time with me and Brandon or somebody to get this done. They're going to have to hire an expert to tell us what the LLC discount is, because the IRS basically doesn't recognize the discount, or they poo-poo it unless you have an expert who signed off on it. They're going to have to get the assets or the LLCs all under one LLC. They're going to have to wait probably a month before they do the sale. They're going to have to set up trusts. But if this LLC is worth $20 million when they die, and they only have $6 million worth of notes in their estate, then it's very worthwhile. And also, if they get sued, the creditors are not going to be able to keep the excess monies. So Brandon, any comments on that?
Yeah, no, I think it's a great plan. I think the other potential downside that maybe wasn't mentioned would be basis in the properties and in the assets upon death may not get a step up. Currently, under current law, there's possible that you could get a step up, but the Bernie Sanders proposals and others out there would certainly eliminate that. So that would be another potential risk there.
Okay, so this is a complicated one, and it's using what we call a net income makeup charitable remainder unitrust. But this client is charitable both as to charity and as to his descendants. So he is setting up a limited liability company, and he is putting part ownership of his medical practice. Actually, it's part ownership of a real estate company that's associated with his medical practice under a charitable remainder unitrust that's going to pay 90% of its value out to him over a period of 20 years. And then he's going to convey that right to receive payments from the charitable trust to an LLC. And then we're going to have the LLC valued by a valuation expert. And if the holding company is worth 350 million, then 90% of that is the payments to the LLC, but nobody's going to pay $350 million or even 90% of $350 million to own that LLC. There's going to be a large discount. Let's say that the valuation firm says that the LLC is worth $250 million, but then he's going to sell a non-voting interest. Maybe that's only worth $180 million. So you've got almost half of the value out. Charity's going to get 10%, and an irrevocable slat for his spouse and descendants is going to get the rest. So we thank Professor Hesch and Jonathan Gottman of the Ackerman Law Firm for talking to us about this technique that we had never thought about. So Brandon, do you want to cover the leverage grat?
Yeah, so this is another potential planning technique here where you have, an entity that, let's say it might be worth $40 million. You can contribute that to an LLC, and then that LLC can owe a note back to the taxpayer, or in this case to Tom Sawyer here, of, let's say, around $40 million. So then there's a $5 million net value in that LLC. Well, then you can contribute that LLC interest to a grantor retained annuity trust, receive back 2 annual payments. That grat interest is going to be valued at $5 million. You could get 2 payments back equal to the $5 million. So you're not making any taxable gift here. And the benefit here is, that takes a $45 million asset, and what you're actually contributing to the grat is only worth $5 million. So those annual payment backs are significantly reduced, not as much cash flow needed to maintain the grat payments, and you're able to transfer significant value outside of the estate by using this leverage technique and not having to have the whole lot of cash flow to support the transfer.
Right, because if ABC LLC is worth 45 million in our opinion, but 65 million in the opinion of the IRS, and we do an installment sale for 45 million, and the IRS audits it, then there could be a $20 million gift, and that would result in $8 million of gift tax and maybe an unhappy client. So we use formula clauses which say I'm giving 99% of this company based on the assumption that my gift is worth 45 million, but if it turns out that it's really worth more, then adjust the percentage. So if the IRS comes back and says, wait a minute, this isn't worth 45, it's worth 65. Okay, well then according to my adjustment clause, I only gave 2/3 away. And the IRS may or may not go along with the adjustment clause, because there are a couple of court cases that went along with the adjustment clause, but the IRS doesn't like it. So the alternative is the grantor retained annuity trust. And if I put assets in a grantor retained annuity trust and it gives me back an equivalent amount over time, then there's no gift made. And under the GRAT statute, if I put in more than I thought I did, there's not a gift. The GRAT just owes me more back. So this GRAT says, whatever you give me, I'll give you back 53% of the day one value in a year and another 53% in the second year. So I put a $45 million stock into that GRAT. The GRAT owes me 22 million or 23 million in year one, 23 million after year two, and it pays me. And then the IRS comes later and says, hey, this was really worth 65. The GRAT owes you another 20 million. Well, you probably detected a little cash flow problem here, because I gave the GRAT $45 million worth of stock, no money, and it's supposed to pay me at the end of the first year and the second year. It could pay me in stock, but then most of the stock would come back to me. So what I do instead is I put the $45 million worth of stock into an LLC owned by my client, and I put in 5 million of cash, and the LLC owes my client 45 million, so it has a value of 5 million, in my opinion, and a value of 25 million in the opinion of the Internal Revenue Service. So I convey my LLC interest to the GRAT, and in my opinion, the GRAT owes me 2.5 million a year for 2 years. If I'm audited, then the IRS says, no, the GRAT owed you 25 million, not 20 million, so pay up with interest. And the GRAT finds a way to pay me, and I should not owe gift tax because of the statutory GRAT adjustment clause. Now, one question that a colleague of ours asks, and he's a well-respected colleague, at least well-respected by everybody outside of his family. And he says, wait a minute, what is the business purpose for this LLC? Is the IRS going to say that you really gave the GRAT $50 million worth of stuff and that it's paying you back a little bit now and then later in a note, and a GRAT can't owe a note. A GRAT's not allowed to satisfy its payment with a note, and the IRS may fold all this and not respect it. So, you struggle with things like this. Is it better because it's got the adjustment clause? Is it worse because you need to leverage it so that the payments can be made? And the answer is a little bit unknown at this time. I personally think it will hold up just fine because taxpayers have the right to arrange their affairs to avoid taxes as long as it's legitimate and legally enforceable. And there are a number of cases where taxpayers at the very last minute put something in an LLC and then sold a discounted LLC interest just a few days later. The IRS said, this is malarkey, you really gifted the underlying assets, and the tax court said, no. In the Holman case, they only waited 6 days between putting highly appreciated Dell stock in an LLC and gifting a non-voting member interest. So I think it works, but who the heck knows? So here is the one we started with, where the PowerPoints went all to heck. And I'll be glad to send this to you. And we may lose our PowerPoints here, but this is a couple who puts $18 million worth of assets into an LLC. They retain the 1% voting member interest, and they have 49.5% each non-voting member interests. They wait at least a month after the LLC is funded with stocks in a bond portfolio or whatever it is. The husband forms a spousal limited access trust, puts a $600,000 seed capital gift. We ask a valuation firm after sending them a check what 49.5% of a $18 million LLC is. Well, you would think it's 9 million, but it turns out to be 6 million. The husband puts a $600,000 seed capital gift into the slat, receives back a 6% promissory note, bearing interest at a pretty low rate. Or if you want the note to vanish on death, it could be a self-canceling installment note, as we talked about last week, and it can be a higher rate. The wife does the same thing on her side. So now you've taken $18 million worth of assets, you've put them into grandfathered, irrevocable grantor trusts. The clients are now down to a $12 million net worth from these assets. You give a 0.1% interest in the LLC to a trust that controls if and when there's liquidation or distribution from the trust, a different trustee than the other trustees to avoid something called Internal Revenue Code Section 2036A2. And now mom and dad pay the tax on the LLC income, get paid on the notes pretty much when they ask for it, because they have the right to replace the trustees of the trust, knowing that when this LLC is going to be worth $36 million in 10 or 15 years, or maybe even sooner, that the only thing in their estate is going to be the 12 million notes. And then if the estate tax exemption is going to come down, they can forgive the $6 million notes and call that a gift. So this is what, a lot of people are doing. Brandon, any comments on that or anything else you'd like to cover? We're a little bit past 30 minutes.
Yeah, just slightly. No, I think this is a great plan. Provides a lot of flexibility for the use of the exemption. If the exemption continues to be at 11 million, we just continue to pay the notes and use our exemption on death. If something happens where we see the exemptions getting ready to go down, we forgive the notes and use up that increased exemption while it's available. So it's a perfect plan for the uncertainty that we have right now, and works really, really well from an estate tax savings standpoint as well.
So for a 66-year-old, as you see here on slide 18, you could do a 7-year note that balloons in 7 years at 4.21% interest. So $421,000 a year on $1 million note. And if Fred dies before the 17th year, the note vanishes, it's self-canceling, it's completely out of his estate. So for our larger clients, we're trying to see what portion of the note should be self-canceling at a higher rate and what portion of the debt should be at the lower rate, recognizing that once we set this, a bill may come out of Congress that will not allow us to play with it later. So those of you who are clients or colleagues or friends and you have a lot of these trusts and these notes, we need to look at what's in the trust, how much the note is, whether it's self-canceling, and whether it should be reset now, because there could be a bill out of Congress, out of the House Ways and Means Committee, which could prevent us from changing these later. So there's one more question I wanted to address from Roy, and it says we want to give a boat to our son. How do we do that? Well, I guess you just don't love your son, because boat stands for bring out another 1,000. So we think it would be better for you to keep the boat, let your son use it, put it in an LLC so you're not responsible if it runs into a wave runner and gets sued, and then you pay to fix the boat. But otherwise, if you want to transfer the boat to your son, you certainly can. So, and I do apologize to Travis and Sheldon, who said that the audio was garbled. Maybe you don't want to listen to me anyway, but this will be put on YouTube. Everybody will be getting a link. And, if there's anyone who you really don't like and you want them to see a video that's not very exciting, then you can recommend this one. I think we will do another one of these next Saturday at 11 o'clock. We really do appreciate all your questions, comments, and suggestions. I hope you'll join us Tuesday, April 20, with Shannon Summerlin and Andrea Foreman. We're going to cover a few very interesting and innovative ways that you can help your favorite charity. So once again, we do appreciate you coming. Yes, thank you for coming, and we'll see you next Saturday. This one's more difficult to run the mouth on. I'm just getting used to it.
So that's a new one, Alan.
Yeah, it's a new one, and I'm really proud of it. It's going to be good. All right, thanks again, and may the rest of your Saturday be a heck of a lot better than this last hour was. Thank you.